10-year yields. Have we reached stability? Tom, do you think so?
I don't think so, in the sense that on a technical basis, the damage was so great that we just have no idea. It depends on which way the line's going, but there's no support or resistance trend path to work with. It's in no man's land. And, it's a cop-out, but it's true. I need more information.
Which is the reason why people are waiting for some stability before saying, OK, I can actually cling onto some sort of thesis. Someone who has been very good with this is Jim Bianco, president and macro strategist at Bianco Research. How much are you just waiting for the knives to stop dropping before you can really go out there and have some conviction?
Oh, I think that's the key, is that you have to wait for the knives to stop dropping. And the problem is that everybody's been trying to catch them, and they've been calling into this trap over and over, or getting their hands cut, over and over again, to stick with the metaphor. But I think what we forgot, and what I've seen in a lot of the discussion about the bond market, was 2009 to 2020 was the QE period. Let me say it bluntly. That was the abnormal interest rate. We have not gone up. I know we've gone up 500 basis points, but we have not tightened by 500 basis points. We haven't tightened by anything close to 500 basis points. The first several hundred or few hundred of that was just getting back to neutral. So the amount of tightening, or the amount of stress that the interest rate market is putting on the economy, I don't think is as great as people think. Which is why tomorrow, when we get GDP, we're probably going to see a number that could very well have a 4 handle on it. And this is the same quarter that in June, right before it started, the consensus forecast was for 0. And we're starting to play that game again, that the economy is about to turn down yet again. We've done this now for a year, that we keep saying this, because the assumption is that these rates are punishingly high. If they're not, then there is room for them to keep going up. And I think that's what they'll do.
Which is the reason why I sense a shift a little bit on the margins of the narrative, this feeling that if bond yields stabilize here, it's not Armageddon. It's not going to cause the demise of any kind of stock rally, but the opposite, that the stability will allow people to come in, buy equity, buy riskier securities, because the economy is withstanding these rates. Do you think that that is an accurate reflection of how people are thinking?
Yeah, it is an accurate reflection that, if things are not as bad as we hope, then, earnings will come through, the economy will stabilize, companies will have a little bit of a brighter outlook. However, you got to also put that against the alternative. And the alternative is a 5.5% money market fund, and maybe very well in the next couple of weeks, a 5% bond fund as well. Dr. Jeremy Siegel updated his great book, Stocks for the Long Run, this year. There's a new edition out. And in it, he says that the long-term return for the stock market is 8%, over many cycles, up and down many, many years. Well, if I get 5.5 in a money market fund or 5 in a bond fund, I'm getting like half to 2/3 of the stock market's gain with no real market risk, or much reduced market risk. So the stock market's got to do something more than just, oh, we beat our earnings and things are somewhat bright and everything's okay. They got to do better than that, because there is an alternative now, and it starts with a 5.5% money market fund.
And Jim Bianco, with the real yield where it is, and you're one of the few people I can talk to this about, you and I remember when there was a great specialty chemical roll-up. Everybody went out, ripped apart the companies that made chemicals and said, here's what's special. It was basically a big zombie roll-up of some productive companies as well. Are we at a point, because of a new real yield, because of a new cost of capital permeating the system, that we get a great merger-thon?
I'm not so sure we're going to get a great merger yet, because I think people are really misreading the real yields, and they're not ready to really react on it, because you hear this, battle cry that real yields at 2.5% on the 10-year tip is at the highest since 2009. Again, it's the highest since the QE period. What was the average real yield from 1997 when they started trading them to 2009? It was 2.7%. And we're at 2.5% right now. So I think once people start to recognize that these real yields are not punishingly high, you might start to see that merger activity start to pick up. But right now, everybody seems to want to wait for, yields to start back down. Earlier, you said, we're going to see the tech companies start issuing bonds. if we did, that means that they think rates are going a lot higher. So I suspect the answer is no.
Late October victory lap, Jim Bianco, folks, way out front of inflation at a level or even ticking higher, as we saw in parts of Europe today. Bianco absolutely nailing that call. Does that signal that the great moderation is over?
I think it is. I think that era ended in 2020. You know, I've been on the show before and I've talked about that. 2020 was arguably the most important economic event of our lifetime, a complete shutdown and restart of the economy globally. And it has now been coming back differently than it was before. And that whole era of zero rates, the great moderation, and I would maybe even talk about top-down index investing on the equity side, you know, might be changing. And now we're going to be looking at more traditional cycles of 3-4 year recessions. And we might be looking at stock picking making a big return after 20 years of being in the wilderness, you know, versus index funds. And we're going to have to start to understand that this is a very different environment.
And Jim, we don't have a ton of time left, but I want to talk about the shape of the yield curve, because what we've seen so far when it comes to this 2s10s is a bear steepening. Typically, it's the bull steepening. That's the recession signal. What signal is this bear steepening sending?
That inflation is not yet behind us. If the Federal Reserve wants to back off of their rate hikes, and wants to say the market is going to do its work, be very, very careful. Because when the market starts doing its work, it will do it. You want the market to slow things down, it will slow things down. Look last year in the UK, when the market didn't like the mini budget and Parliament wouldn't do anything about it, the market stepped up and did something about the mini budget, and Liz Truss couldn't last longer than a head of lettuce. So be very careful when you say, let the market do your work, because it will do it, and it will do it in a way that will scare you. And that's why we think we're getting a bear steepener right now.
10 more questions. We'll get to them. Jim Bianco, thank you so much with Bianco Research for another time on some of the vicissitudes of the American financial system. Jim Bianco there, just folding in the economics into the equity market as well. Speaking of the equity market,